Good morning. Thank you for joining us today. My name is John West, and I am Head of Client Strategies at Research Affiliates, and it's my pleasure to host today's webinar, Timing Smart Beta. Research Affiliates' mission centers on bringing transformative insights and products that benefit investors, and it's along this line of thinking and motivation that we've spent considerable time and effort this year exploring smart beta. What are the drivers of return to smart beta and factor investing strategies? What should we be mindful of today as we implement these strategies for the future? And what are portfolio construction considerations that go along with these findings? And so to share the main conclusions of this research, I'm honored to introduce Mr. Rob Arnott, our firm's founder, chairman, and CEO. As a reminder, the audience is on listen-only mode with all lines being muted. And in response to the feedback we received from our last webinar back in April, we very much want to reserve the majority of our time together for Rob to answer your questions. So if you do have any questions, please feel free to submit these using the right-hand dialog box. A PDF copy, furthermore, of this presentation and the paper we recently published are available for our download on our website. With that, I'll turn it over to Rob.
Thanks, John. Trend chasing exists in our industry everywhere. When it comes to academia seeking tenure, professors will try to find interesting ideas, new ideas that haven't been published before. Is that going to involve a certain amount of data mining? Of course it will. Are they going to publish ideas that didn't work in the past? Of course they won't. And so there's a quest for the best historical performance. Practitioners in developing products want ideas that will add value for their customers, that will win for their customers in the long run. So again, they're looking for the best historical performance. Asset owners, investors, are they going to look around to try to find products that are trading cheap because they've performed horribly in the last 3 to 5 years? Of course not. Most people just don't behave that way. So you have selection bias in identifying strategies and ideas that have worked in the past. You have data mining in the quest for new ideas and strategies that can be introduced. And how often do we find a published article that looks at some new factor, some new strategy that hasn't been explored before, in which the author asks the very simple question, is this strategy, is this factor, is this idea trading richer than it did in the past? Is some of the historical alpha simply a revaluation of the strategy relative to the past? Should I subtract that? We don't see that in any of the published articles about smart beta strategies, anomalies, or factors. We argued in the first of our series of papers, the paper entitled How Can Smart Beta Go Horribly Wrong?, that investors should, and academia and practitioners should partition the alpha into a revaluation alpha, the portion of the alpha that's simply due to the strategy becoming more expensive, and separate that from the structural alpha. Now, the division between the two of these is not clean and neat because the revaluation alpha itself is a little squishy. But if a strategy has become much more expensive than it was in the past, there's a very good chance that there's an illusion of alpha that is not, in fact, the reality. And when you're looking at data spanning even decades, this can show up. Low beta stocks 50 years ago were trading at half the price to book value of high beta stocks. Now they're trading at 50 to 100% higher price to book value than high beta stocks. So the revaluation can actually be quite startling, even over periods measured in decades. Let's start with this exhibit, which also appeared in the very first of this series of 3 papers. It looks at the classic Fama French value factor. Now, how's that constructed? You find the 30% of the stock market that's trading at the lowest price to book value, that's the value portfolio, and you cap weight it. You find the 30% that's trading at the highest price to book value, and you cap weight it. And then you track the difference in performance between those two portfolios, and you reconstitute the portfolios once a year to make sure that the value portfolio is always value and the growth portfolio is always growth. That blue line is the performance of the value factor. And as you can see on the left scale, it goes from 1 to 3 over the last 50 years. That means that the investor in the Fama French value portfolio after 50 years is 3 times as wealthy as the investor in the growth portfolio. Value has worked on average over time. But I marked several points on this graph. Point B, 1977. Well, that's when Sanjoy Basu published the first major academic article identifying the value factor. Isn't it interesting that this paper was published after a stupendous 5-year run in which value beat growth by more than 15% per annum for 5 years? Well, it's interesting but unsurprising. Would Basu have noticed the value effect 5 years earlier? I would argue no, he probably wouldn't have. Was he data mining in identifying the value factor at that time? Yes, I would argue he was data mining. Was this nefarious or ill-intentioned? Of course not. Was it wrong in the sense that the value effect doesn't exist? Well, actually, if you look at performance of the value effect relative to its own valuation, you find that it's a very legitimate factor. So, applause for Sanjoy Basu in identifying the value effect and in identifying the value factor. But roll the clock forward 23 years to the year 2000, marked in a C. Notice that the blue line has gone down over the 23 years, up for the first dozen years, down for the latter decade or so. My goodness, 23 years with no alpha. A lot of folks were firing their value managers left and right during the late stages of the tech bubble because that blue line was tumbling. Value stocks, value strategies, value managers, value funds were outperforming the growth and technology funds. What wasn't done previously was to plot the green line. What is the green line? The green line is the relative valuation of the value portfolio relative to the growth portfolio. And this is simply using price to book value because that's the measure that we used to construct the value effect in the first place. It's the classic measure that's used most often in academia. And of course, this same approach can be evaluated using other measures like price earnings or price to sales. But in any event, if an investor had access to this information, the green line, they would have noticed, gosh, the two lines are joined at the hip. At point B, when Basu identified the value factor, that green line, if you scan across to the right scale, is at about 0.3. What does that mean? It means that the value side of the Fama French value factor was trading at 0.3 times the valuation of the growth portfolio, meaning growth was 3 times as expensive as value. By the peak of the tech bubble, it was down at 0.08. By the peak of the tech bubble, growth was priced at 12 times the valuation of value. Now, an investor looking at the blue line at point C would say, gosh, value has been a disaster. It's been horrible the last decade. It hasn't worked since Basu published this idea 23 years ago. I'm out. I'm giving up on value. An investor looking at the green line would say, oh my goodness, this is trading twice as cheap as it was at the peak of the Nifty 50. I don't dare bail out of value at this time. Roll the clock forward again. 2006, shortly before the quant crash of 07, the valuations were back up to the 0.3 range, and the performance was at new highs. And then finally, rolling it forward to point E, early 2016, value had had a nightmare decade. The Russell Value Index underperformed the Russell Growth Index by 2% per year compounded for 10 years. My goodness. And again, people are saying Value's not working. I need to diversify away from this. But if they had the green line, they would say, oh, this is trading cheaper than at any time in history except the tech bubble and the global financial crisis. It's trading cheaper than it was at the peak of the Nifty 50. Well, that's interesting. Maybe I shouldn't bail out of value. It turns out you can do this same kind of analysis on any factor, any strategy, and in theory you could do it on any mutual fund. Here we're looking at 4 popular factors: momentum, the small cap effect, low beta versus high beta, what's sometimes called the betting against beta factor, and high profit margin versus low profit margin companies. The 2 graphs on the right, you'll notice that the lines are joined at the hip. They move up and down together. This means that when small cap is underperforming, it's underperforming because it's getting cheap. When small cap is getting more richly priced, meaning the green line is going up, almost always it goes hand in hand with small cap beating large cap so that the blue line is rising. The same holds true for profitability. Why are the lines joined at the hip? These are strategies where the turnover is low. Small cap does not become large cap very quickly or easily, or vice versa. So the turnover between the 2 portfolios is modest. The same thing holds true for high profit margin and low profit margin businesses. So they're joined at the hip. Now the 2 graphs differ in one important respect. The one on the upper right, there's a wedge. The blue line performs better than its underlying valuation on the green line. So small cap is trading in line with historic norms. The green line is approximately in range of its historic norms. If you scan back and just gauge what the average would have been, it's about at average valuation. And yet, you wind up 3 times as wealthy with small cap as with large cap over the last 50 years. That wedge between the 2 lines is structural alpha. The ups and downs, where the lines are moving up and down in parallel, that's revaluation alpha. That is something that is non-recurring that we can't count on. Now look at the bottom right. If you're using gross profit margins as a measure, the blue line goes up. There's a historical alpha, but it's because the green line has gone up. It's because it's gotten more expensive. There's no wedge between the 2 lines. The gross profitability measure does not seem to have any structural alpha, and yet think how popular it is today. Why so popular? Look at the last decade. The blue line has gone up nearly 100%, and it's because the green line has gone up nearly 100%. High margin companies are trading at nearly 100% higher valuation multiple than they were trading just 10 years ago. If you look at the graphs on the left, you can see also a similar contrast. The graph on the upper left, momentum, has a wedge. There's a structural alpha. Cool. The one on the lower left, low beta, does not. There's no wedge there. Now, the bottom 2 have no wedge. One is high profit margin, one is low beta. They're up over the last 50 years because the green line is up, because valuations have gotten richer. Think about it. Why should you earn a higher risk premium for a lower risk or higher quality portfolio? It doesn't make sense to expect a structural alpha from low beta or from high quality. The 2 graphs on the left differ from the ones on the right in another important respect. The green line and the blue line are not joined at the hip. Does that mean that momentum is a wildly volatile strategy in terms of its performance? No, the blue line is not wildly volatile. What it does mean is that the changes in the green line are as often due to reconstitution of the portfolio as they are due to revaluation per se. So while we can say that low beta does seem to have a positive historical alpha because of upward revaluation, we can also say that shifting composition makes that a very noisy relationship. It's even more so for momentum. But momentum is famous for its crashes. Look at the blue line. You see these spikes and crashes where momentum suddenly is wildly successful and then crashes. It's a seductive strategy in that regard. Look at the green line wherever the blue line hits a peak. The green line is usually also at a peak. So with momentum, even though the relationship between the two lines is weak, the simple fact is when momentum is telling us to ramp up our exposure to nosebleed valuation bubble stocks, that's a time to switch off momentum. We can go back and do an evaluation of historical long-term returns. Well, gosh, here's 8 different factors, 2 measures of value, book to price, and a blended measure: momentum, small cap, illiquidity, low beta, gross profitability, investment. These are all very, very popular, widely followed factors. Most of them have statistically significant historical alpha over the last half century. All of them have positive alpha. How much came from revaluation? Well, that's a little squishy. Simple revaluation would suggest that the alpha net of revaluation is statistically significant only for 4 of these: value, both forms of value, small cap, and illiquidity, and may actually be negative for gross profitability and for low beta. If you use a regression-based approach to evaluate the portion of returns that's due to revaluation, you wind up with a structural alpha that's positive and statistically significant for 5 of them and negligible for 2. We published in our second paper evidence that factor valuations are predictive of future returns. I'll start with the one on the upper left. If you look at price-to-book value valuation ratios, recall that sometimes value is trading as cheap as 0.08, sometimes as rich as 0.32. That means that growth is anywhere from 3 times as expensive as value to 12 times as expensive as value. Each green dot is a point drawn from the last half century, and the horizontal axis is the starting valuation ratio of value versus growth, and the vertical axis is the subsequent 5-year return. Well, lo and behold, any time that value is trading cheaper than 0.15, 1/7 the price, the valuation ratios of growth, anytime it's trading at cheaper than a 7-to-1 ratio, value wins. The next 5 years, the return is positive. Does this mean I believe that the odds of success are 100% when it's cheaper than this? No, there could be outliers that fall below the line in the future, but the relationship is undeniable and powerful. Small cap, undeniable and powerful, and currently trading a little cheap. The blue and the gold large circles tell us where we are today. Russell 2000 is at 0.6 times the valuation ratio for the Russell 1000, and that ratio is cheap relative to history. Of course, small cap has performed badly the last couple of years. That's the nature of whatever's cheap. It's likely to have inflicted pain and losses recently. Momentum's trading a bit rich relative to history. And, well, some critics have justly suggested that looking at momentum and comparing today's momentum valuation with next 5-year return is an irrelevant measure because the composition of the momentum portfolio changes every single month. That critique is absolutely legitimate, and yet that dashed black line tells us that even that relationship is pretty powerful. When momentum is trading this rich, it's not likely to add as much value over the next 5 years as historic norms. The solid line traces the linkage in the relationship on a short-term basis, not a 5-year basis. And here what we find is the relationship becomes stark and powerful, and whenever momentum is trading rich, it's not likely to help us. Low beta, trading top decile of historical multiples. What this tells us is that low volatility strategies that anchor on beta in order to construct their portfolio are likely trading pretty rich and might not work as well as we would like to expect. The relationships are robust internationally. This shows that same graph for value. The green dots are the same as they were on the previous exhibit. The large green circle tells us where we are today in terms of valuation. The gold dots are for IFA, and the purple dots are for emerging markets. The linkage is roughly the same for all three. And if history is a guide, current valuations for value would suggest that historically, whenever it got this cheap, value beat growth by an average of 8% per year for the next 5 years. For the gold dot for IFA, when it got this cheap, on average it won by 11% per year. And in emerging markets, when it got as cheap as it is today, on average it won by 22% per year. Do I believe that value is going to beat growth by 22% in emerging markets? No way. But the relationship is awfully powerful, so I do believe that we're likely to see value beat growth by a very impressive margin with rather high odds of success. This graph is a rather busy graph, and it's important to understand it. I'm going to start at the far left. Gross profitability, popular quality metric. The leftmost bar, which goes from 1.5 to 2.5, tells us that using an aggregate blend, price to book, price to sales, price to earnings, and price to dividends, high quality companies with a high profit margin trade anywhere from 1.5 to 2.5 times the valuation of low profit margin companies. And what do we find here? We find that right now we're right in the middle of that range. If you use price to book, that's the next line, the dash blue line. On average, the high quality, high margin businesses trade at 2 to 4 times the price to book value of low margin businesses. Well, right now they're at 4 times. So this would say, watch out. You've got a mixed signal. Based on an aggregate blend of measures, quality measured by gross profitability is trading fair. Using price to book, it's trading rich. The next 2 lines are for international markets, for IFA. High margin businesses are trading rich no matter how you measure it in international markets. The next 2 lines, vertical lines, are for emerging markets. For emerging markets, high margin businesses, high quality businesses are trading sensibly relative to low margin businesses. So this factor is probably just fine in emerging markets. It might be okay in the US, it's a mixed signal, and it's awfully expensive in international markets. Momentum's expensive everywhere, but it's worrisome only in IFA. In US and emerging markets, it's trading rich, but not off the charts. In international markets, in IFA, it's off the charts. Low beta is off the charts everywhere. Illiquidity, Roger Ibbotson's favorite metric, sensibly priced in the US, rich outside the US. Small cap, a little cheap in the US, rich outside the US, especially in emerging markets. Investment, somewhere between neutral and expensive in the US, a little cheap in IFA and emerging markets. And value, well gosh, value is anywhere from sensibly priced to really cheap all over the world, especially outside the US and most particularly in emerging markets. So this graph packs a lot of information into a very compact form. Now it turns out you can use the same thing with smart beta strategies. On the far left, we're looking at a widely used quality index, which is a popular approach for quality investing. And again, we can compare current valuations with historic norms. Quality almost always trades at a premium, so the vertical lines are above 1 in almost all cases. In the US, it's a mixed signal. Quality is sensibly priced, probably won't hurt you, might even do rather nicely. Outside the US, watch out. Valuations are at historic extremes. Maximum diversification. Sensibly priced in the US, a little dangerous outside the US. Now, this is a strategy that has very high turnover, so my reaction to this is, gosh, take another look at it a year from now and it might be cheap. But today it's probably not. Equal weight, fairly priced in the US relative to history, at a valuation extreme outside the U.S. Risk efficient, Ed Heck's strategy. Cheap in the U.S., neutral in international markets, a little expensive in emerging markets. Low vol index, trading rich pretty much everywhere. But if you add in a valuation measure, which FTSE RAFI low vol does, it becomes a little more sensibly priced, but still not cheap. Even our own low vol strategy is trading a little rich. As for value measures, the most popular is dividends. Well, the quest for yield in a zero interest rate world is becoming so intense that dividend strategies are trading a little rich. Fundamental index is trading cheap. And so as we look at the spectrum of strategies in smart beta land, we find a lot of them are trading rich, especially outside the US. And the ones that focus most heavily on value, like fundamental index, likely to perform pretty well because they're trading cheap. The FTSE RAFI low vol is kind of a blend of low volatility and fundamental index, and so its results are in between the two. Low vol is trading rich, FTSE RAFI low vol is trading less rich, and fundamental index is trading cheap. Most investors are trend chasers. I'm not going to spend a lot of time on this exhibit, but if we look at all mutual funds, we find that the dollar-weighted return is about 2% below the return of a buy and hold strategy holding all funds. And all funds perform awfully close to the performance of the S&P 500. All right, so the notion that mutual funds systematically lag the S&P, well, maybe there's a little bit of truth to that, but the much more powerful implication is that the average investor gets way less than index returns because they keep chasing performance. The dollar-weighted returns are lower because the performance of the funds tend to be best when they have a low asset base and tend to be worst when they have a large asset base. Academics are trend chasers too. Here we look at 8 popular factors, and we look at the year when that factor was first published. Value was first published in 1977, momentum in 93. Rolf Bonds wrote about the size effect in 81. How did they perform from 1967 until the publication year? And how did they perform after the publication year? Well, gosh, before the factor was discovered and published, on average, you had 500 basis points of alpha attached to the factor. After publication, more than half of it disappeared. Ouch. This means that when you look at historical alphas, you'd better give it a big haircut. The same thing applies to a lesser extent for smart beta strategies. Strategies like fundamental index, first launched in November of 2005, the equal weight index first published, not first researched, but first created as an index that you could look up on Bloomberg in January of 2003, and so forth across the row. Before the launch of the index suite, the average return relative to the market was 1.8% alpha. After the launch, 1.4%. Roughly a quarter of the alpha disappears after launch. So, does this mean we can do better by chasing performance or by shunning performance? Well, here's a provocative set of exhibits. Let's take the smart beta strategies. Let's equal weight all 8 of them. Now, this tacitly assumes that we could have known in 1977 that all 8 strategies could be constructed. We could build a portfolio equal weighting all 8 strategies. Of course we couldn't do that. But if we could, we would have earned a 1.5% per annum excess return over the S&P 500. Now, let's suppose we do what most investors do. Let's look at the trailing 1, 3, 5, and 10-year returns. And let's blend that so that we're looking at how big an outlier each of these strategies is over each of those 4 spans. And we choose the ones that have the best blended 1, 3, 5, and 10-year past performance. If we do that, well, gosh, initially, the first few years, you do better. But since the year 2000, you do a lot worse. What's going on there? Well, those first few years, that's when these strategies were earning the returns that got them on people's radar screens and got them published and created as products. Subsequent to the year 2000, it all unravels, and in fact, subsequent to 2005, chasing performance in smart beta strategies would have given you no alpha at all. The blue line flatlines. For factors, it's even more dramatic. If you equally weight the 8 factors, based on a ridiculous presumption that you could go back to 1977 and could have identified those 8 factors to begin with, well, keep in mind, those factors were identified because they had worked and were published between 77 and today. That black line tells us that you would have earned 2.4% alpha by being long the long portfolio and short the short portfolio in the factor. It's a 200% portfolio. It's a leveraged portfolio. That's why you get such a large alpha, 2.4% per year. But if you buy the 3 best performing factors, half of the alpha goes away. Now remember from the last exhibit, half of the alpha goes away as you go from performance before the factor is published to performance after the factor is published. So if you lose half by going from backtest to live, and you lose half by chasing the best performing factors, the reality might be 0 alpha. Let's suppose you had the courage to buy the worst performing 3 strategies or factors. You would have done 70 basis points better per annum compounded by buying the worst performing smart beta strategies, and 90 basis points per annum by choosing the worst performing factors. This suggests that maybe there's something that can be done in factor timing gently and in a broadly diversified fashion that can add some value. So let's look at the most and least expensive. We saw the graphs earlier suggesting that some of these strategies are trading rich relative to their history and some cheap. Instead of choosing the ones that performed best or worst, let's choose the ones that are most or least expensive. And lo and behold, the 3 least expensive smart beta strategies gives you 2% per annum alpha, 0.5% better than equal weighting the 8 strategies. Choosing the most expensive gives up almost half of your alpha. Choosing the least expensive factors gives you more than double the alpha of equal weighting the factors. Factor timing works, but you gotta factor time in a contrarian fashion by lightly overemphasizing the ones that are least expensive and de-emphasizing the ones that are most expensive. Now, whatever is most expensive is likely to have delivered great joy and great profit, so it's very uncomfortable to lighten exposure. Whatever's least expensive is likely to have been very disappointing, inflicting pain and losses, so it's even more uncomfortable. But as you can see in this graph, each green dot tells you that for that particular year, that particular strategy, the dividend index across the top, for instance, the green dots tell you which years the dividend index was one of the 3 cheapest relative to its own history. Fundamental index tells you which years it was the cheapest. Those are the green dots. You also find times when each of them turns out to be among the most expensive relative to its own history. And over on the far right, you see that as of 2016, the 3 cheapest relative to their own history are FTSE RAFI Low Vol, Risk Efficient, and the Quality Index. The 3 most expensive relative to their history are Dividend Index, Low Vol, and Maximum Diversification. But every single one of these strategies sometimes is one of the 3 least expensive, sometimes one of the 3 most expensive. Same thing applies to factors. There are times when value is among the most expensive, notably right about when Sanjoy Basu published The Value Effect. There are times when profitability is cheap and when it's expensive. And so if you look over at the far right, you can see which strategies are represented in the most and least expensive strategies. So to conclude, contrarian timing, buying what is cheap relative to its own history, and de-emphasizing expensive can improve your performance. Trend chasing, buying what has performed well, chasing past performance, especially paper portfolio performance, oh my goodness, we saw how much damage that can do. Last, concluding comment, while relative valuations can provide a useful signal to time factors or smart beta strategies, it makes sense to do it in moderation, because if you do it in a highly concentrated form, the performance improves, but the risk goes up sharply, so that your Sharpe ratio actually goes down. Doing it with moderation, as for example, choosing the 3 cheapest relative to their history, allows you to have a higher return without degrading the Sharpe ratio. Thank you for your time. Let me open it up to questions.